The ETF business was built around the index business. It looks like now we might see some of these ETF brands actually superseding the indices they were based on. Here to discuss more about this is Eric Balchunas with Bloomberg Intelligence, who covers ETFs for us. And you actually have written some analysis about this. So what's the competition here, if that's the right word for it, and why is it a problem?
Yeah, well, you would think the growth of passive would be great for index makers, and it has been. And stocks like MSCI and SPGI are up double the S&P. They've been having a great time. Now, issuers like BlackRock and Vanguard and State Street have been taking it on the chin by having to lower fees. So while passive's good for the index maker, what's coming could be a big challenge, because when money goes to passive, it's not just going to passive, it's going to the ultra dirt cheap, absolute nearest to zero passive. There's a chart showing flows of all funds over the last year, and if I did that for 3 years, you'd see the same trend. In other words, the big bar is 0 to 10 basis points, and then it goes down. So you can see, I call it the great cost migration. And these issuers, these asset managers, are only going to incur these costs for so long. They're going to do everything they can to pass it downstream. And I think that is going to present a challenge for index makers who make a lot of their money from the licensing fees, because ultimately in 5 or 10 years, if everything is 1 or 2 basis points for your whole portfolio, there's not much money for anyone, and the asset manager isn't going to make nothing. So this is a dire situation.
So in other words, the ETF issuers will put pressure on the index makers to reduce their fees.
Correct.
Because they are under pressure to reduce their fees.
Totally, and they may dump them. We've seen some cases of self-indexing, but renegotiation, and most of them are vulnerable.
So what about branding here? Because you can do that, I guess, if you have the brand power on the ETF side. But if you're really linked to the index brand power, you don't have as much flexibility, right?
Right. So the only index that I think is probably above all this is the S&P 500. Those ETFs are on fire. They account for 16% of the assets, but a quarter of the flows. I don't think anybody's going to mess with that. But like even MSCI, right? Vanguard dumped MSCI indexes back in 2012. Everybody thought it was a gamble. But since then, the 12 funds that dumped MSCI have taken in $600 billion. And this is consistent with survey data we saw from ETF.com and BBH of advisors, who said 60% of them said the index is less important or doesn't matter compared to the ETF brand. So I think as the ETF brand gets bigger and bigger, it will have more pressure on it. And BlackRock also has gotten into this. They dumped Barclays out of 12 big bond ETFs in 2013, and those saw $60 billion in inflows. And this week they put out 2 ETFs that self-index. So this is the first time BlackRock is starting to track their own indexes, and that to me also is another sign that they are looking any way possible to cut fees.
Really interesting. Really quickly, smart beta, how does it fit into all this? Do they use indices, or do they create their own? How does that work? Right.
So smart beta, there's a few cases where they might use MSCI factor index, but largely now you see Fidelity, Goldman, these big shops, because they're all smart beta is repackaging active. So when you come in as Fidelity, you're just going to repackage yourself, create your own Fidelity index, and then have an ETF tracking it. So that's going to further ice out those brand name index makers. So smart beta, even though you can charge a little more, it's not necessarily good for those brand name index makers, because a lot of them aren't going to be used because the issuer wants to use their own secret sauce.
All right.